Treasury markets dither over the future path of interest rates. Welcome to Market Insight. I'm David Pollard. Treasury yields slipped today after weekly jobless claims increased much more than expected, but they remain elevated. Only yesterday, the Fed's Boston president, Susan Collins, said the economy needs to cool off before inflation can return to target. This coming amid the fierce ongoing debate over the outlook for rate cuts. Well, to discuss this and more, I'm joined by Adam Abbas, portfolio manager and head of fixed income at Harris Associates, which manages Oakmark funds. Welcome, Adam. Many thanks for joining us today. Let's start with that. Does the economy need to cool before inflation can come down and the Fed can cut rates?
Well, I'm not sure I agree with all of that. I would amend your statement to say that inflation coming down against the current backdrop is more a function of time than demand. Although when you are in restrictive territory, I realize those are linked. But why do I say time is a more important variable? I think if you look at rents, market rents, they do show, and Jerome Powell alluded to this in his latest commentary, they do show line of sight for shelter inflation coming down over time. That's a big component. We also look at wages and look at the supply coming online there. It also points to an alleviation of some of that upward pressure. So it really comes down to how does goods and services and those other buckets respond over the next 6 to 12 months. I think we're still in restrictive territory with 5% rates. I don't think that's up for debate. I think as some of this fiscal policy recedes a bit, it'll alleviate some of the upward pressure in the economy, and supply demand will normalize over time. And I think ultimately we can get down to 2%. It just may take longer than we expected, over the last 6 to 12 months.
For the time being, the yield curve is still negative. Where is the recession that usually signals, or has the bond market gotten it wrong, or indeed has that correlation between an inverted yield curve and recession, has that broken down?
Well, I think it has broken down a little bit. I think it's important to note that it's unique what we went through over the last 3 years with the COVID shock, and then really having to plug a lot of monetary and fiscal stimuli into the economy. Like, we just passed 624 days, I believe, passing the longest inversion ever back to 1978. And so, yeah, I think it's in post-Volcker era, this is much different in that we had to respond with a lot of liquidity in the system, and the Fed had to move up rates a step function higher, all the way to 5%, to try to counteract some of that excess liquidity. It's not as though in past cycles where we had the back end of the curve really respond by coming down and create that inversion. In this case, we really just have the front end of the curve coming up in a step function manner, and the back end of the curve staying actually quite normal. So I think if you were to see the belly and the back end of the curve come down a lot, implying that growth was coming to a halt, that's where you're concerned. I think the verdict is quite clearly still out.
So the FOMC this month slowed the pace of quantitative tightening from $60 billion to $25 billion per month. Is that a gesture to dampen any hit to monetary conditions from QT, or to show a gradual managed approach? And what impact may it have, do you think?
Yeah, I think this is more about signaling. I think it's more about, hey, look, we're starting the off-ramp from the tightening cycle, from restrictive policy. We're not really ready to make any real changes with the policy rates, but we're going to start to alleviate some of the supply concerns. It'll alleviate some of the concerns around too much supply in the market. And this really is just a nominal, it amounts to $35 billion in roll-off is the change. I think mortgages are held flat. So we're talking about a multi-trillion-dollar market. I think it may help on the margin, but this is short-term technical in nature, and I don't think really changes the fundamental backdrop whatsoever for how we think of value for fixed income and Treasury specifically.
Now, in your notes, you take a very long-term bullish position, which you say is rooted in fundamental factors. So what are those factors? And shouldn't we be worried about the huge total US debt pile, which is well over $34 trillion?
Well, we should worry. I mean, I think that is what the bears are focused on, is really solely this supply story that is technical and that relates to the budget. We think it's relevant, and certainly if we keep spending like we're spending, I think there will be issues down the road as deficits grow at higher rates, and those the cost, the burden, and this treasury supply compounds. Our view at Harris Oakmark is always going to be underpinned by a long-term fundamental view. And that view is that high current nominal rates and high current real rates compared to what we experienced over the last 15 years make this very compelling today to compound at, let's say, 2 to 3% real returns for patient, just buy and hold investors. I don't think you want to overcomplicate that. You want to put your capital in 5 to 7 year fixed income, high quality, well underwritten bonds and let that compound over time. And I think if you look 5 to 7 years out, you're going to have very attractive real and nominal returns versus what we faced over the last 15 years, which was negative real yields and just, low single digit nominal yields. Today, we're much higher than that. And I don't think it needs to be any more difficult than that.
Okay, Adam, we'll leave it there. Adam Abbas of Harris Associates, many thanks for sharing your thoughts today. That is your Market Insight. You can watch more videos on Reuters.com.